All right, we're going to go ahead and get started. Hope everybody's having a great day. My name is Tyler Braun. I'm the Director of Financial Planning here with the Tranel Financial Group. I'm excited to talk to you today. We've had a lot of questions. So I talked to Jenna about this right after the election. And I said, Jenna, we've been getting a lot of questions. And I thought the name was very appropriate of November 5th. Now what? Because that's been the number one question I've gotten from clients over the last, 3 weeks, post-election is what can we anticipate? What can we expect? So this is a live webinar, just so you're aware. So on the bottom of the screen, there should be a button there that says chat. All you would need to do is I've got a few of our co-workers. Jenna's actually on this webinar with me, and she'll be able to field those questions and get them over to me. We'll also leave some time at the end for question and answer. So if you have specific questions as I go through here, I've got about roughly 30 minutes worth of presentation to go through. If you have specific questions, that are going to pop up about anything, just jot that note down or type quickly in the chat section, and I'll be happy to go through those with you at the end. So with that, let's get started here. So November 5th, now what? So I'll start every good meeting with an agenda. We're going to be covering 4 key topics. So where are we right now? We're going to talk about what's going on. We're going to look ahead, right? Things to be aware of. And then there's opportunities. And that's really the theme. I've had this theme for about 2 years now doing these webinars, and it's really called With Change and Volatility Comes Opportunity, right? And that's going to be the key piece that we look at. Let me get rid of it. It's popping up down here. All right. So the first piece is what's going on, right? So we look at these pieces. This is what you hear in the news all the time. So taxes, tariffs, less regulation. I put a question mark in there because these are a lot of, I don't want to say pipe dreams, but wishes that are out there. World unrest, interest rates, unemployment, and then opportunities. So I'm talking a little bit faster because we have a lot of information to cover. There is a lot of moving pieces that are happening right now, and I want to make sure that we have enough time to cover each of these. So once again, if you have questions as we go through, please go ahead and put your question on the bottom, and we'll dive through them in detail. So the first one that we're going to talk about is just where are we at right now. So I want to start by just looking at the S&P 500. So the S&P over the last year has had a great year. You can see over the last, 12-month cycle, it's up almost 28%. 83% of the time during an election year, the market ends positive. So this is on pace to be no different than any of those years we've seen previously. But really, if you look to the right, in the last month, so since the election, you can see the S&P is up almost 6 percentage points. So it's up 5.88% in less than a month, right? And you're going to see this trend continue with the Dow. So remember, the S&P 500 are the 500, right? Large cap US companies, right? That's a broader index, and that index is actually almost 35% technology. So very heavily weighted in technology, where the Dow Jones is 30 US based companies that cover a broad spectrum of different indexes, so different sectors specifically. It's only about 18% technology, which is why you can see over the last 12 months, it's only up about 18.78% compared to the S&P being up closer to 27. It doesn't have as much technology exposure to it, hence the difference. But one of the things I'll point out on here is look at the last 1 month to the right of the screen. You can see the Dow is actually up 7.19% over the last one month compared to the S&P being up only 5.88. So almost a 1.5% change in uptick over a 1 month period. Now, some people would look at that and say, well, that's just people taking their gains off the table. That could be some of it. But also included in this is the next conversation we're going to get to, which is taxes and tariffs. And this is where it all starts coming together for us. So if we look at it, I think everyone on this call right now is having the same epiphany where we're looking at it saying a 1 month return of 5.88 and a 1 month return of 7.19%. That's fantastic. That's great. Why did the market react so positively to Donald Trump winning the election? Right? And just note, this is not a political webinar. This is not a political conversation. So this is just pros and cons to different pieces that are occurring in the marketplace that I want all of you to be aware of. So as we look through the first piece, we're going to talk about why the market was so euphoric and why we saw such a run up in the month here after the election is really the Tax Cuts and Jobs Act is looking to be extended. So in 2017, when President Trump put changes into place, what he did, and you can see from a individual standpoint. So you and I filing our tax returns in 2017, President Trump rolled back the tax brackets for individual filers. So you can see if you were in the top tax bracket before of 39.6%, that rolled back to 37%, right? 33% bracket dropped to 32, 28% bracket dropped down to 24, 25 to 22, 15 to 12, and the 10% bracket stayed the same. So what that means is the individual is paying a smaller amount of tax on the dollars that they earned. So that's from the individual standpoint. Those are looking to be extended. They were going to sunset in 2025, which means that they were going to go away in 2025, which means we were going to see taxes go back to what they were under the Obama administration, which means they most likely would have defaulted to the higher brackets that you see on the left side of the screen. So that was a celebration where people said, hey, we don't have to pay as much in taxes going forward if they're extended. Also, we saw standard deductions stay elevated. So in 2017, the standard deduction that you get to claim on your tax return increased exponentially. You can see for a married couple in the year 2025, the standard deduction is going to be $30,000. That's a huge amount. What this has done is it's simplified the tax code. And people ask that question, how does a larger standard deduction simplify the tax code? The IRS, right, has to do a lot more work when they have to look through a return that is being itemized, right? That's all that gray area. If it's a standard deduction, they don't have to worry about how much you paid in interest on your mortgage, how much you're paying in state and local taxes, all those different pieces. So over 85% of Americans file their taxes with a standard deduction now because of that elevated price. It makes that process a little more simplistic. So with the extension of the Tax Cuts and Jobs Act, right, we will see that elevated standard deduction. They're talking about increasing that even further than where it is right now. So that's from the individual standpoint. Okay. But you just have to remember the individuals, as much as I wish we could say we have a ton to do with the market movement, corporations really have a lot to do with where the market moves, right? Showing profits and losses. And this is the bigger piece to pay attention to with taxes and why the market was celebrating so much. And we saw such an uptick over the last 1 month. So from a corporate tax standpoint, in 2017, what they did is reduce corporate taxes from 35% to 21%. And that's what's being extended. And that's why corporations are showing profits in the short term, is because what we're seeing now an extension of that 21% corporate bracket and possibly even more corporate tax cuts in addition to that. So if you look on the right-hand side of the screen there, what's interesting is if you go back to 2018, when the Trump tax cuts took place, right? The average corporation, and they pulled 296 of the largest corporations in this poll, were paying approximately 22% as their effective tax bracket in 2018. After the Trump tax cuts occurred, that tax bracket effective rate dropped to 12.8%. So that's almost a 10% savings in taxes. Now, if you put yourself in the shoes of the corporation, if you have revenue coming in and you pay less in taxes, you're keeping more of that revenue, which means you show higher profits, which leads you right to the second portion, or excuse me, the third bullet point. If you look on here, you can see the largest corporations that showed continuous profitability, regardless of who the president was. In 2018, they saw corporations rise in profit by 44%. So think about that. They're paying less in taxes, so they're showing a higher profit, which moves the market, right? One of those pieces, obviously, if a corporation can show more profit, their shares are more valuable. Hence, we see a price increase in that share price. And that's what we saw that first month here, the first, 27 days since the election. where we've seen investors in corporations being rewarded because they're anticipating lower taxes going forward than what they had paid previously. So that's the euphoric jump there that we saw in the short term. Now we hear that and we look at that and we say, well, this is great. Lower taxes means more profit. But also, what we have to take into account is that next T in the conversation, which is tariffs. And this is the number one question we're getting. And there's so many questions out there about this. Okay. So I'll just start number one with what is a tariff? So a tariff is basically a tax that's being put on imported or exported goods that's being paid to a government. So, for example, if we import something from China, if a corporation imports something from China, the United States government could say, hey, we're going to put a tariff on that product that you're importing, which means they're, in essence, implementing a tax on that product for bringing that product from another country and not manufacturing it here inside the United States. Okay. So when we look at that, I put a couple bullet points on here. Tariffs can be used to protect domestic industry or generate revenue for the government, which is what we've been hearing a lot. But tariffs can also create uncertainty, and they can absolutely disrupt global supply chains if you are not prepared for that tariff. Okay. And one of the bullet points I put on here that I'm going to come back to is possible tax breaks in the future for creating products in the United States to help avoid tariffs. But this is something that's very real. If you listen to President Trump and his administration talk, they are talking very heavily about tariffs, right? They're saying, hey, we're going to implement possible tariffs of 25% on Mexico and Canada on day one, right? That would be something that would, be a shock to the system. They're talking about implementing possibly an additional 10% tariff on top of China's already tariffs that we hold, right? A lot of these that you're seeing, right, are starting points. We've already seen the president of Canada, the Prime Minister of Canada, come down and meet with President Trump in anticipation of that. We've seen some news today about, Mexico starting to meet with President Trump. So it's a talking point to get them to the table. So I don't want to overreact to a positive or a negative in any one way, shape, or form. But just be aware, a tariff is a form of tax. The hard part with the tariff is that tax is usually handed on to the consumer, right? Meaning you and I. And that's something we're going to talk about with inflation as well. So when we look at tariffs, just be aware, tariffs are already at hand. They're already in play, right? So right now, if you look at the left-hand side of the screen, you can see that's highlighted in red. That's when the trade war occurred. And you can see how both the United States and China really ratcheted up those tariffs that were occurring during that 2-year time period from 2018 to 2020 until we reached what was called the Phase One agreement. So when we look at it, you can see right now, China has a tariff on U.S. exports into China of 21.1%, right? We're already paying a tariff to China, and we have approximately a 19.3% tariff on certain products that we're importing from China. So both countries, both the United States and China, are implementing tariffs on each other currently under the agreement we had back in place in 2020. Now, you can see listed below, there's tariffs on what's called the rest of the world. That's the row that you see there, right? The United States is implementing approximately a 3% tariff on the rest of the world. China is implementing approximately a 6.5% tariff on the rest of the world. Now, when we look to the right here, it shows that China is currently subjecting 58.3% of our products that we're exporting to China, right, with tariffs. And the United States is subjecting 66.4% of the products that we import from China with tariffs. What they're talking about is increasing those numbers even above or beyond that into other countries outside of just the United States. So if we look back at 2018 and 2019, you can see a couple of the headlines here. And this is one that I had just pulled today, right? Where it talked about the volatility that occurred in the market when tariffs started, right? And I want you guys to just, think back to 2018 and 2019. At one point, the market in 2018, it was down approximately 20% from its high. So it had dropped a little over 18% from where it was at its high when these tariff conversations started. Now, that was the ripping the band-aid off moment, and it was a knee-jerk reaction. We saw the market recover fairly quickly after the negotiations had started. And you remember there was back and forth banter between both countries on coming up to a resolution. What's interesting about all of that is those tariffs are still in place, just like we talked about before, right? So when we look at a tariff, as we talked about before, that's one of those pieces where I go back to my initial piece here, where it starts to create a form of or of anxiety because there's so much unknown. Okay. So when we think of a tariff, put yourself in the shoes of a global company that's here inside the United States. If all of a sudden on day one, the administration comes out and says, we're going to implement a 25% tariff on any product you import from China, and let's say all of the widgets that you import are from China currently. Well, you just saw a 25% increase on that product cost, and you have to figure it out on day one. That would be a shock and awe to the system, and we would see volatility because it's change and it's forcing change. What they're talking about doing and where the volatility comes from is how this is packaged and how it is announced. Okay. So if the corporate or if the administration comes out and says that you have until X date to find a distributor or create the products inside of the United States, and they don't rip the band-aid off till a certain date, there's going to be less volatility because it gives corporations and companies the ability to go find those supply chains inside the United States to avoid that tariff. That's one option. Another option is the administration is talking about reducing taxes further if you create the product inside the United States. So what they're saying is if you want to import it from China, you're going to pay an additional, let's say 25% in that example. Or if you manufacture that product inside the United States, we're going to reduce your corporate taxes from 21% down to 15% on all your revenue, which is a huge tax savings. So they're looking to possibly incentivize corporations for bringing jobs back to the United States by reducing their tax burden to help offset any of the tariffs that are in place. That's a long-term objective. Short term, it can create uncertainty and volatility because they have to work out that supply chain, and everything is so interglobally connected now that it does not just happen overnight. So this is a very complex issue, but what I want you guys to take away from this is going to constantly be changing over the next few months. They're talking about tariffs now on certain things. They're going to get to the negotiation table. They're going to come up with a different agreement, and that way they go, right? So what you're hearing in the news from a tariff standpoint today is probably going to be something completely different a month from now, a quarter from now, and as they negotiate these. But tariffs are something that we're watching very, very closely. What we're watching from the nerdy side of the investment table is the corporations that our clients invest in, how reliant are they on importing products from other countries? That's something we want to continue to pay attention to, and you should pay attention to as an investor. How reliant are these companies on importing products from other countries, right? And what percentage of the product that they're importing is coming from other countries that could be, adversely impacted by tariffs? Okay, that's the first point. The second point we want to pay attention to is are these US-based companies, right, that are importing the products or making the products in the United States, is their number one client base inside the United States or outside the United States? Meaning, are they exporting the majority of their product to another country and selling it? Because if they are, that's another flag that we have to watch, because the issue behind that is if we get into a tick for tat tariff war with another country and that company is reliant on selling products to that other country and they're going to get hit with a large tariff, that means sales will most likely decline. So what we focus on is, right, we're looking at US-based companies that have the majority of their revenue generated inside the United States to avoid that tick for tat tariff issue that we were talking about before. The next piece I want to touch on is really some of the things that you're hearing in the news as well, which is less regulation and the governmental deficit. Okay. So with less regulation, right? That sounds, honestly, I hear that. That sounds okay, right? But within reason. Okay. So what they're talking about is the Department of Government Efficiency. This is something in the news you hear with Elon Musk is heading it up and so forth. Same thing. There's a lot of, I don't want to say promises, but there's a lot of terminology that's going around about cutting everything out of the government and having, less infrastructure and so forth. For a lot of things, that's easier said than done. The government is the largest employer in the United States. Just remember that. Okay. So it is a huge, huge animal, and there is bureaucracy on top of bureaucracy. And I think we can all agree there probably is some, overspending on certain things, but we also need government for a lot of other things, right? So what they're looking at doing is saying, how do we reduce the deficit? And are we overspending on certain areas? And I'm not here to get into if we are or are not, but just remember that the United States is the largest, employer in the United States. I don't necessarily see them coming in on day one and terminating all the employees. And I've heard that from different clients. They're going to come in and terminate all the different governmental entities. No, we would see unemployment skyrocket inside the United States if they did that, right? If the largest employer in the United States came in and fired two-thirds of their workforce, you would see unemployment spike through the roof. And then that leads to a whole nother conundrum of issues for the Federal Reserve to come through and have to unwind with interest rates, inflation, all those different pieces that they would have to work through. So that is not something I see happening or fearful on day one, where they're striking an order and all of a sudden all governmental agencies are gone. That's not something I think that any of you need to lose sleep over whatsoever. Just be aware of that piece. Right? The governmental deficit is really what we continue to pay attention to, and will it continue to grow? Right? And it has continued to bulge and grow. We're over $34 trillion of deficit as a nation. So we do need to, at some point as a nation, control that spending. But I don't necessarily see it being something that just happens overnight where we need to worry about mass layoffs from governmental employees, et cetera, that would be occurring. So don't lose any sleep over that whatsoever. There will be change, and with change comes anxiety. But I do think that it'll be more prepared and planned out, and I do not see that being an issue that we need to address any further. World unrest. This is another talking point, right? Ukraine and Russia has been a talking point for some time, and so has, China and Taiwan. Those are still there, right? The only thing I have to talk about on this slide is we're so blessed to live inside the United States, right? So in terms of Ukraine and Russia, right, one of the talks is to get them to a negotiating table with China and Taiwan, right? We're looking at those pieces and a lot of what's occurring in both of these situations is outside of your control and my control, right? So just do not lose sleep over things that we have no direct control over, but be aware of it being there, right? So for example, if we're here to talk about financial planning, from a financial planning standpoint, one of the key issues with Taiwan is they are one of the largest semiconductor, exporters. They are the largest semiconductor exporter in the world, and we are heavily reliant on them for our technology, right? If they were invaded by China, we would lose that technology and lose that trading partner, and we do not have a replacement for it, right? So that's something we continue to monitor and watch. With Ukraine, right? That's a bigger global scale with dealing with Russia and so forth. But same thing, do not lose sleep over things that we cannot control. Interest rates. Okay, so interest rates have begun decreasing now based on reduced inflation. So inflation, the CPI report was over 7.8% back in July of 2022. Since that time period, it has began to taper, right? And it's continued to come down. Now, I know some of you on this call are looking at this saying, I'm going to the grocery store and things do not seem a whole lot cheaper, right? I understand that, but the CPI report, the Consumer Price Index, only looks back over the last 12 months. And what they're doing is saying over the last 12 months, we've seen inflation grow, but at a considerably lower or slower pace than what it was growing at before. The Federal Reserve is targeting a 2% inflation rate, and they were starting to achieve that rate, so they started to decrease interest rates. So when inflation is running rampant, That's a sign that the economy is overheating. So what they're doing is they're raising interest rates to make lending more expensive. So when they do that, if you're paying more interest to the bank in your mortgage, car, etc., you have less cash flow left over because you're spending more on interest. So your spending decreases, your desire to buy things decreases. It strategically cools down the economy, right? Which eases inflation. When inflation has reached its level of comfort for the Federal Reserve, they start decreasing interest rates. And what that does is it reduces how much you spend in interest, whether it's credit card debt, car notes, etc., right? And that means you have more cash flow left over because you're paying less in interest. And in turn, you can spend more money, which sparks economic growth in the economy. So experts right now are looking at continued decreases into 2025. So we should see interest rates continue to decrease into 2025. But the big piece, which is the third bullet point listed here, is we do have to watch out for inflation rearing its ugly head with tariffs. So if we see a 25% tariff or a 10% tariff from different countries and we're importing those products and that cost has to get handed over the consumer, right? That's an automatic inflation that occurs, right? From a corporation standpoint, they'll weather some of that, meaning that they're going to, build that into their profit margin for a period of time, but then they're going to hand that over to the consumer. And history shows that they hand those tariffs over to the consumer and it ends up being a tax on the consumer long term. So if that does occur, and we see that from a multitude of places, that could increase inflation in the short term, which would slow down the decrease of interest rates. So the reason I bring that up is some of you on this call might be saying, hey, I'm looking to refinance my house or refinance my car note. Interest rates should get lower. But one thing to pay attention to is interest rates could peak back up if inflation comes up due to the tariffs. So just pay attention to that. Also, in addition to that, we have to continue paying attention to what we're investing in. And what I mean by that is if you're on the fixed income or the bond side of investing. And the reason because that becomes more important, if my arm's a teeter-totter, if interest rates are rising, bond prices are falling. So if we see tariffs occur and we see inflation start to rise, a lot of people use bonds as a safe alternative to equities or stocks, right? They view that as a safe haven, and certain bonds absolutely are, but not all bonds are created equal. So if we see people sell their equities and go to the bond side, thinking it's more safe, and all of a sudden interest rates start rising because inflation starts going back up, you would see a reduction in the net asset value of those bonds. They would lose price just like that, right? So we have to pay attention to that. So key takeaways to go through here. Number one, as we talked about before, the market is celebrating lower taxes for corporations and individuals. That's why we've seen the uptick here in the past 27 days in the market is just celebrating those lower taxes that I talked about early on. Tariffs are going to create uncertainty, right? When we look through that short term, so I tell clients, I've been saying this for weeks now, short term, I'm a realist. Short term, we've got some different things that we're going to have volatility around. Long term, I'm optimistic, right? Meaning that investing in the United States and long term, right? Just like Warren Buffett always says, right? Invest in the United States and see your money grow long term. I'm right there with him, right? Less regulation can be good and it can be bad, right? So I know it sounds like I'm talking out of both sides of my mouth, but too much of a good thing is a bad thing. You guys ever heard that? So less regulation can create some systematized processes to streamline some things and make it more efficient, but it can also be used to the negative where we need regulation for certain entities and certain things. We need to look at using assets differently to take advantage of the volatility. As I talked about before, if inflation spikes again and we need interest rates to go up for the US economy, we got to make sure we're in the right areas. We also need to look at things that can hedge inflation, right? And diversify your portfolio. One of the easiest ways to overcome volatility is just diversify the portfolio in a way that is comfort to your goal, right? And then the third way, or the last piece that we'll have as a takeaway, is you need to look to insulate your cash flow, right? So one of the ways you can do that is through yield or dividends. So regardless of what's occurring in the economy, you still have the cash flow there to cover your monthly need, and you can wait for the economy to grow and the assets to continue to compound long term. So four and a half talking points, because I have two built into one here that I want you guys to take away from this call, okay, from an opportunity standpoint. Okay. Now is a great time, and I've been having this conversation for the last 6 months with clients to harvest some gains as the market's at close to an all-time high. So if you've got a big expense coming up, or you've got a trip coming up, or you have something that you've been planning on doing, or you're saying, you know what, income's okay right now, but I know I'm going to need a raise probably in the next year or two. Now is a great time to harvest some gains off of your growth bucket. Let's shift them, get some increased dividends, or pay for that trip or something that you have coming up, right? Just because we've had a great opportunity here with the market, right? Know what you're invested in. And I know that sounds really easy. I'm invested in these two companies. No, know what you're invested in. Okay. How would it be impacted with tariffs? We can do the research back to 2018, 2019, do an overlay to say what's the impact that we should prepare for, et cetera. Know what you're invested in, how it will be impacted. Look to reallocate for the future. If you're a younger investor and there's volatility, what a great opportunity, right? And I know that sounds crazy, but if you're making contributions to your account, volatility is your best friend. Where volatility works against you is if you have this big nest egg of funds, nobody wants to see this $1 million turn into 800 before it goes to 1.5, right? We want to protect that nest egg and let it continue to accumulate over time. But if you're a young investor and you're making contributions in your 401k, for example, remember you have your current holdings and you have future contributions. Current holdings you can allocate completely different than what your future contributions are going to be. And your future contributions are money you have not yet made. So if there is volatility, you're buying something that dipped the most inside the portfolio at the biggest discounts, you see the biggest gain over time. So there's ways to take advantage of that. And then, as I talked about before, there's opportunities for contributions, whether that's reinvesting your dividends, making contributions into the accounts at the right time, but also insulating your income from the volatility. Right? We talk a lot about what we call recession resistant holdings that pay a nice dividend, and that's items you need regardless of what's occurring in the economy. And that's a way to hedge that risk to generate the income that you need so you still have assets accumulating in the background that we don't have to touch or liquidate principal if there is volatility in the markets, right? So with that being said, right, my playbook for how to be successful is just continue to focus on companies that you need their product regardless of what's occurring in the market. Take that a step further and know how they're positioned, meaning are they importing product and reliant on that for a large portion of their revenue? Are they generating most of their revenue inside the United States by selling that product, or are they more generating the majority of the revenue overseas, right? Are they positioned for future growth? There is absolutely growth to be had, right? You see a reduction in taxes extended like we're seeing, that leads to more revenue and profit. That typically leads to good long-term growth, right? Focus on the longer term. There's going to be volatility at some point, regardless of tariff conversations, regardless of taxes, all these things. There's always going to be volatility at some point, but continue to focus on the longer term. You're investing in good companies for a reason because you know, like, and trust their product and you use it. That's the biggest piece, right? Add to your accounts throughout volatility if you're able. They call that dollar cost averaging. That's the number one way to take advantage of volatility and use it for your benefit. As I talked about before, insulate that income, utilize different ways of generating income where you don't have to worry about selling principal. So that removes that volatility factor, right? Look at income now versus income later, and that goes into harvesting those gains. And as I talked about before, you're in it for the long term, right? You're not investing for tomorrow, you're investing for your future, and that's long term. So with that being said, I'm going to stop sharing here and I'm going to open it up to questions. If anybody has any specific questions, I know we covered a ton of material, but I want to be here if you had any questions to get them answered.
We have two questions to start, Tyler. We got two questions to start. One of them says, please address the impact of the 2025 market and economy to push by Trump to promote cyber currencies. I understand that there might be a new ETF for this market.
Hmm.
It
So
just ended.
yeah, so cyber currencies are another term for like cryptocurrency and so forth. Right
Right.
now, it's hard to go into detail because they're completely unregulated, right, thus far. So there are different ETFs out there and so forth. The United States actually at one point got into what was called stablecoin, and they were talking about that. And that was a digital currency that the Fed was looking at. I don't know if they went more specifically on it. There are different pieces that the government's looking at from a digital currency standpoint. I think everyone on this call knows that the world is getting faster every single day. And it wouldn't surprise me that 10 years from now, there's no longer cash. It wouldn't surprise me. So a digital currency um, would or could replace that at some point. But I don't have any specifics on that at this point, Jenna.
Okay. That makes sense. Thank you for that. I have another one that says, thank you again for this clarity, which you did a great job, Tyler. Thank you. With the new administration, what happens if regulations on the market are taken away? Could that be a possibility?
That's a great question. Most of the regulations that they're talking about are on different governmental agencies. So, the Department of Education, the Department of um, agriculture, all those different, and making them more driven by the state or making them driven by the open market that would be out there. Uh, the protections that they have on the market, the SEC and so forth, those are self-regulated entities, so they're not driven directly by the government. So they're self-regulated. So FINRA and the SEC is who regulates market movement and so forth. Those are self-regulated entities that have their own fees, generated fines, etc. So I don't see that being a big change or a big difference from what it is right now whatsoever. One of the pieces that would still be in place is they would still have the monopoly rule. And that's the one that
Right.
you would have to watch where you don't want a big company coming in and buying all its competitors. And I do not see that being removed whatsoever because it would remove the capitalist type mindset of the United States. That would be the biggest one to watch, but I don't see that being an issue.
That makes sense. That makes sense. Thank you for answering that. We have one more question that came in. It says, how does harvesting growth into some dividend type funds or stock compares to bonds as a protection strategy?
Yeah, good question. Good question. So typically you would say, let's say you had a portfolio that was $1 million and that $1 million grew to be 1.5 million over the last 2 years. So you've got 500,000 of gains and you're saying, you know what, I might need to put $200,000 into a house next year. So you're saying, hey, I've got this 500,000 of appreciation. How do I, in essence, protect that? So one idea is you could take it and put it into a bond, and that bond is less risky than your growth holdings that you had. So let's say you were invested in some technology stocks or something like that. So its bonds would be less aggressive than those. But the issue is timing, right? So not all bonds are created equal. So if you're holding a bond and interest rates rise, bonds will actually could fall in value based on what type of bond you're in. And, if we look at the historical run, equities typically grow more than what bonds do. So looking at a dividend focused type portfolio would be more of an income play in that example. So you're saying what I'm doing is I'm taking and removing it from a sector that might have been technology that was considerably more aggressive, and I'm shifting it over into a more defensive equity that's still going to grow over time, but it pays me a really attractive dividend. So that $500,000, for example, if we shifted that over to the more conservative bucket and said, hey, we're going to take the dividend of 4% and I'm going to generate some additional cash flow for me and my family, that's a $20,000 a year raise. Plus, you still have the underlying dividend equity appreciating in value as that stock goes up. And historically, it doesn't show as much volatility as what the tech stock would show.
Thank you. Those are all of the questions that have been submitted. You did a
Perfect.
phenomenal job, Tyler. Thank you.
Thank you. So if anybody on here has any additional questions, I know we went a little bit longer than the 30 minutes I thought we would go, but if anybody has any additional questions, please feel free to reach out to our team. That's what we're here for. You can email us, and we're happy to have a conversation with you further in detail. but appreciate all of you and I hope you have a great rest of your day.